All right. POIs in the chat, please. Starting in 3, 2, 1, go. I think OG do a good job of explaining how the US monetary policy could affect other countries. But the problem is, in as much as the responses required in different countries might be anti-correlated, it's not clear how structurally you're able to help the rest of the world without also screwing over some of the rest of the world. I'm going to do two things in this speech. The first thing I want to explain how it is we think US monetary policy is able to help the rest of the world. And I think implicitly that will respond to a lot of opening opposition's arguments. Secondly, I want to explain why we think that now the Fed is much more likely to be hawkish and have high interest rates, and why we think that's going to be very good for the vast majority of the world. So firstly, on changing US monetary policy, I think that most of the world has very, very correlated economies. Why is that likely to be the case? Firstly, there's a large correlation in monetary policy, in as much as the US having lower rates means that people are more likely to go into other countries, into their bond markets, which drives down the rates there, which means that the monetary effect on markets is likely to be relatively correlated. Two, the US is often the main consumer market, as is pointed out, and spends huge amounts of money, which means that if the money dries up in US markets, this means that everyone else around the world that tends to be exporting to them and the Europe, which has similar economies, again, for much of the same reasons, will then lose a huge amount of spending internally, which leads to correlated recessions. But thirdly, as is pointed out, that most loans are denominated in USD, and therefore the amount that people have to pay is correlated to the amount of inflation there is. What does this mean? It means most of the time when there is a financial crisis in the United States, there is also a financial crisis, for instance, in the Eurozone, or when there is a financial crisis in Asia like there was in the 2000s, it also has a substantial effect in the United States. What does this mean for the debate? Firstly, it means that I think to a large extent, we might be able to prove OG's benefits because they say that they don't explain why it's likely this correlation exists and therefore how you're structurally able to help. But secondly, I think it means that most of the impacts that opening opposition wants to talk about are relatively unlikely, because it is true that many countries may be net lenders and many may be net borrowers, and it's not clear structurally why this means that the Fed is likely to net out and having lower interest rates, which I think undercuts the vast majority of opening opposition's claims. And if it is the case, therefore, that most of these things are correlated, what we can say is, by and large, what the Fed will do is tend towards the policy which is internally recommended and externally beneficial, and that will have good outcomes. I think probably the problem with this argument is that they're perfectly correlated, then it shouldn't really make a difference, right? Like just following the dual mandate would in and of itself be sufficient to guarantee the correct monetary policy for the rest of the world. What we think happens is that most of the rest of the world tends to have a higher cost of bubbles, that is bubbles pop faster and harder, and tend to have slower recoveries, which means that if the Fed cared about them, what it would do is probably tighten somewhat earlier and have more hawkish monetary policy to prevent the risk of these bubbles from becoming astronomically large, because other countries are more at risk of these bubbles becoming extraordinarily problematic, and then after recessions being significantly more easy than they otherwise would. Why do we think it is that countries have a higher risk when bubbles are likely to happen in the United States and then correlated bubbles in the rest of the world? The first thing is that people have far fewer savings and far less wealth for them to rely on, which means the extent to which consumer spending dries up is likely to be substantially less, but this is often the thing that makes the economy going. And when it dries up very aggressively in other countries, this means that they have substantially worse outcomes. The second thing is these countries are much less credible, which means that people are far more worried that they're not going to be able to repay their debts, and the race out of these countries is substantially more aggressive, and their capacity to use fiscal responses, for instance, by taxing their population, is substantially lower. What does this mean? I think, one, it means in most instances, if the Fed cares about the rest of the world, it is likely to tighten substantially earlier. Tightening earlier means that countries are less likely to rack up substantial debts, which means they're unable to pay them, but also moves the total amount of debt accumulated in between each business cycle to be substantially lower, which means that although on net this might lead to slower growth, it leads to substantially less huge shocks to these economies. I think on net this is a thing we care a lot about, because one, for the worst economies, often the benefits of easier borrowing are often not felt because inflation is so high that they can't benefit from it. But secondly, these are specifically the circumstances where people are left without any jobs or access to health from their government at all. And we think this is the most important impact. But secondly, I think even if you do care about financial crisis, we're likely to often ease substantially easier. The Fed in some instances has incentives not to do that, for instance, so it can not get too close to the zero lower bound that opening opposition wants to talk about. Now they're far more likely to have easy credit for the rest of the world that allows them to recover much better. A good example now would be COVID, where easy credit would allow the majority of the world to recover. I think this runs into some risk of OO's case, but it's not clear to me why, given in general there will tend to be correlated responses needed, why the divergence from optimal policy in the United States is going to be so bad that it leads to all of the impacts that opening opposition wants to talk about. Secondly, OO says the Fed is going to be much more dovish. This makes very little sense, because if it is the case that the US is structurally dovish, then other countries are likely to borrow very, very aggressively because they're going to have their monetary policy forced downwards. And there's strong short-termist incentives for governments to keep interest rates low. So in the short term, they get as much economic growth and employment as possible. The reason this is bad is I think it leads to huge amounts of inflation, but due to bad borrowing all around the world. That is, people will often be spending, but these loans will not actually be spent on stuff which is optimal or pays off in the long run. The impact of this is then when you don't get useful capital expenditure, people still have obligations to pay back, but they don't have, but you often have a shortage in supply that can't meet the additional spending that leads to a large amount of inflation and unsustainable debt. So one, in as much as they care about debt, this is probably higher under their side because people are going to be borrowing substantially more aggressively and particularly on unproductive labor. But two, the rate of inflation in the worst countries is likely to be very, very high because these is likely to be very high. In the long run, this means the benefits of easy credit dry up because these countries are then the rate of inflation is sufficiently high. The instability means people are not believably able to pay back their debt anyway, or it's not worth anything. So even if the rates are more preferable, people still don't want to invest. I'll take opening.
Your claim about homogenous countries is a lie. Recovery periods across the world differ based on things like GDP and geographic locations. Tightening earlier will screw over countries who are lagging recovery, but when they're then also
the premise of this, you can't say more than one thing. The premise of this is literally GDP and geographical location. Those are not mechs I need to respond to. If you want to make an argument, you can make it to David. I think the reason this is bad is the reason this is good is I think it makes the risk of China becoming the world's reserve currency much less, because for a reserve currency, people generally want currencies with relatively low inflation because this one means that you tend to have large amounts of stability in the pricing of the goods that you want to trade, and people in general want that stability because then they don't have to take hedges against currency fluctuations that are quite expensive to hold. But secondly, because it means that when you're holding this in expectation of spending it, it's not likely to dramatically depreciate. The US now is likely to face substantially higher inflation than China because China has tried quite hard to get its reserve currency status. Why would it be so bad if China is able to get this? I think it'd be so bad because this gives them a huge amount of power to make people trade with them. For instance, when it wants to use currency manipulation and increase people's debt burdens as a way to try and force them to be more reliant on China. Making the US structurally have tighter monetary policy makes this much less likely to happen. Very proud to propose.
We thank the member of government very much for the frank speech, and we're happy to call upon the member of opposition.